Today on Cornell Keynotes, we're joined by a power trio of real estate experts from the Cornell Nolan School of Hotel Administration to make sense of real estate market trends and understand what's going on with conversion of office to anything else spaces. We'll learn why back-to-office efforts still remain weak in many urban cores, while those same downtowns are actually experiencing booming retail, entertainment, and even cultural visitation. Lots of challenges, but also lots of opportunity for financiers and real estate investors. Be sure to check out the episode notes for info on eCornell's catalog of online real estate courses, all authored by today's guests. Listeners, here's our conversation with Jan DeRoos, Gene Varney, and Daniel Lebray.
Our title is nominally called Real Estate Right Now, and can it transition from toxic to timely? We're going to start with a lightning round on each of the five major property classes. You can only answer one answer. It's hold, buy, or sell for each of, and we're going to start with multifamily. What do you think, Gene? Hold, buy, or sell?
Hold.
Daniel?
I'm a little more optimistic, so I'd say that it's going to be time to buy.
Okay. I'm hold and be opportunistic. Number two for retail. I'm sorry, for industrial. Let's say number two, industrial logistics properties. What do you think? I'm going to go with you, Daniel, first.
I'll hold.
I'll hold too.
I'll hold. Those property types have been darlings, but maybe it's time to hold at this point with increasing vacancies in that sector. Retail, is retail ever going to be good again? Daniel, hold, buy, sell.
Again, I'm just neutral. I think retail has gone through a lot, but it also has now, absorbed a lot of what was going on. So I'll hold on retail.
I'm going to say it's really specific and dependent on the location and the scale of retail. It has settled. I'll agree with that. Yeah.
I'm going to go with hold. I live in a different place from them. Rather than upstate New York, I live in Western Florida, and retail is crazy here, but it is also there's a lot of it. So this one's going to be easy. Office buildings, hold, sell, or buy.
There's just a lot of unknown yet with the office space. I think there's a good 40% of the leases that have not renewed yet. So I'd be cautious with office, and I would not touch it too much.
Agreed.
People that didn't sell earlier are really feeling sorry for themselves, and now they're catching a falling knife. And I would say office is very difficult to make the argument to hold. I'd be looking to sell. How about entertainment or lodging facilities? What do you think?
I would say, again, very, very market specific. And we'll probably get into that a little bit today as well. But we've got some really stabilized numbers. So in general, I would say hold, but it is very market specific.
Yeah, I completely agree with Gene in saying that depending on the type of properties you're looking at, the market, the segment, the location. But overall, I think it's still healthy, and I would hold right now hotels.
I would hold and look to buy selectively. I think it's a great asset class. And I think hotels have sort of regained their footing after being some body blows with both the reservation systems and with Airbnb. They're a really viable short-term alternative now when people need transient lodging or transient accommodation. There's a whole series of what I call specialized asset classes out there now. One of the things that's impacting the industrial logistics space is you don't put your data center or your cell tower or some of your other special properties inside of one of those facilities to make it work. You build a specialized facility for it, and there's a whole industry around either cell tower, data centers, or storage. Anybody care to comment on those types of assets?
Well, what I was able to gather, for example, about data centers is that they had a hard time just making a case for themselves over the years, and that with AI emergence, it's become a hotter asset class. So it's all perhaps in line with what the AI business model would turn into, and could make a strong case for data centers going forward. Self-storage is working great as far as I understand it. So those two, seem to be, increasingly interesting.
One of the real niche classes that I follow is casino, which is flipped to a net lease model. And it's fascinating. I think the net lease REITs will do well, and I think casinos are going to continue to do well as they expand their their traditional experience offerings.
Yeah, and they're recession-proof. So, I mean, in many ways, they seem to be a great way to adjust risk-adjusted returns. Casinos are great assets. I mean, it's not surprising that a lot of private equity has stepped into casinos.
Well, I see them as sort of, they're not the natural long-term holders. What they do is buy opportunities and sell to the REITs who then
Correct.
Yep. So, Gene, anything to add with that?
Actually, just a sort of a side note, a lot of these special use buildings have really hit the ground running with sustainability. And a lot of the construction has been really amazing in the efficiencies and what they're putting in place with some of these. So I just wanted to chime in on that.
So I have a set of sort of macro forces that are going to impact us. All of us said, well, it depends on location and sub-property type. Let's drill into that a little bit. What do you think of the macro forces that are going to impact both valuations and returns? Gene, why don't you pick up on what I think is a big one, which is sustainability. And I'm going to go with the formal ISO, or the International Standards Organization definitions of sustainability, and then more broadly climate change.
From a sustainability perspective, it's such a huge topic, and it really, covers so many pieces of a puzzle that affects valuation, for real estate. The environmental side, we've seen a significant increase in regulations, in owner reporting requirements, and measurements and tracking. And so that's a piece that I think everyone is paying much more attention to. So when we look at the energy side, we've seen, I think, kind of a stabilization in costs of energy, but energy efficiency has become, more important than ever, paramount. The ISO side, actually, ISO, the International Standards Organization, actually has a lot of great resources and tools for building owners to use to help them set up standards and systems and programs and protocols. So they're a very, very good tool. Certifications also are driving value in real estate. There's a lot of perception of healthy environments, more efficient buildings. They are much more attractive from a leasing perspective. Their occupancies and rates are usually double digit over non-certified buildings.
Does it hit the capital markets in terms of either a tipping point, either you will or you won't lend, or is it underwritten into underwriting either a lack of sustainability or positive sustainability? Daniel, have you seen any evidence of that, or is it still too early to tell?
It does impact the lending ability, I think, in the sense of like how it impacts the cash flows. So that's certainly something that lenders will take into account, whether it's from an energy efficiency standpoint, the efficiency costs. Insurance are related. Insurance costs are definitely related to some of the climate change provisions that Gene was talking about, and those have a strong impact on the cash flows. And then there's also this entire story about whether capital is becoming more, adept to clean sort of like investments. And so that may also have an impact on the cost of capital, whether you're investing in certain type of properties that are sustainable or not.
Any other comments on the larger forces that are driving valuations, driving returns in terms of really either capital markets or on the what I'll call space side, population changes, employment, or user preferences changing?
So the three main aspects that I have on my radar right now, and it's hard to make the claim that they are autonomous or independent from one another. So I'm going to list them without necessarily ranking them. Number one, the drop in interest rate, cost of capitals have reached the level they have right now. I think there is a consensus that interest rates are about to decrease, but no one has a clear picture about how quickly they're going to drop and how far they're going to drop. I think that's a question mark that impacts not only the real estate and the commercial real estate sector, but the broader economy. And we'll certainly see how that plays out over the next 12 to 18 months. Second, I would say, are we going to experience a soft landing or are we going to hit a recession? There's a lot of uncertainty around the labor type of data that we're seeing. There's an important talk tomorrow and important statistics that are going to be released. It's probably going to shape in some way and form the Fed policy in terms of rates. Is it going to be a quarter point? Is it going to be half a point? Those are going to be important. And then the last major macro force is that we are in an election year. And with the presidential election, with control of Congress, with a variety of things, you could see different policies being put in place, fiscal policies, et cetera, et cetera. So all of these things are obviously related, and they will impact for sure commercial real estate markets going forward.
I want to chime in a little bit more on the labor side. Labor has become an enormous issue in pretty much every industry. The shifts in worker preference, the shifts since COVID of where people thought they were sort of slated for certain traditional employment opportunities have found all kinds of different opportunities. The availability of work online, certainly the shift in worker preference for being in the office versus not in the office has had a tremendous impact on commercial office space, which we'll talk a little bit more about as well. But it really, the labor force is impacting actually real estate itself and, user or worker preferences, for that. And certainly pressures from organized labor and inflation rates, labor rates going up, discussions of minimum wage increases and different markets having different minimum wage standards, also, putting pressure on the labor models as well as the financial statement from a labor cost perspective.
So let's link this all to what's going on in capital markets. So Daniel started with, okay, we don't know how far it's going to drop, and I agree, it's clear that interest rates will drop over the next quarter. Is that a sustainable thing? Is it something that's needed to stimulate, or is it really it's time for the Fed to take its foot off slowing things down in the capital markets and speeding up? Because clearly if interest rates drop, transaction volumes and overall financings will increase.
Yeah, so, I don't have a crystal ball. And we just look at, the situation right now and try to think through step by step. I think that the obviously cost of capital now has reached the point where it's fully priced in the market. Property values have captured what the impact of this high interest rate environment is. I think it's turning a corner from the commercial real estate markets overall. And now we are facing a decrease in interest rate environment. In certain time periods, certainly over the last decade, rates have been near zero for a long period of time. That helped boom the entire commercial real estate sector. It's very unlikely that it will go back to zero. I think most economists' opinions that I read and I see is that most probably rates will go higher than zero. And then how quickly they'll drop may have something to do with whether the economy is stronger, resilient, if we have a soft landing or something like that. What it does is certainly open capital and makes funds available for properties that are facing maturity on their existing loans at a more affordable rate. So that's something that is certainly going to be welcome and alleviate a lot of current borrowers as they are facing the impending sort of decision of what they're going to have to do next over the next 2 or 3 years with these loans that are coming due. And that is obviously a challenge for both the borrowers and the lenders. But there are certainly other aspects that are also going to play a role, like what sources of capital are going to be coming into the market. Are we going to see investors transacting mostly from the private equity world, REITs, institutional, cross-border capital coming? I think, we have seen a lot of institutional and cross-border capital taking place in 2021, 2022. And typically when we face a more challenged real estate market, we see REITs and private equity stepping in first as they find opportunities. And so that's what I would expect also, a lower interest rate environment with movements coming from the private equity world and from the REITs world first, as they're able to identify opportunities, strategical acquisitions and things like that before we see again institutions and cross-border capital coming in. What else? What other aspect we should talk about?
Well, one of the things that I've seen is this sort of maturity tsunami, that so-called, with trillions of dollars of debt coming due, or at least hundreds of billions of dollars of debt coming due, depending on the sector. That has turned out to be not that big of a problem, but that's actually, to me, where the rubber hits the road on hold versus sell. I've seen a lot of recent refinancing transactions, individual transactions where the borrower has to write a check to pay off the old debt because the new debt size is smaller. And that's clearly, I'm going to hold this asset strategy rather than defaulting and saying goodbye to it. As the markets come down, that will make that a lot easier, but I'm wondering if there's enough capital there to meet the need.
Well, and that's again a very interesting question. A lot of the capital that was needed at times came from abroad for things like that, or came from the private equity world, and it will depend on the appetite of these sectors in taking on that role in recapitalizations, as you're saying, on injecting new equity in order to lessen the burden from the debt side. So, there is appetite. I'm seeing lenders willing to work on refinancing, but the underwriting criteria is tightened up. LTVs went down a little bit. Coverage ratios also went down. So it's harder to get access to this capital, to the debt capital, which requires, therefore, an increase in the equity check. How much control are you losing for that equity? How much, you're willing to part away from in order to bring in some of this new equity and keep the deal floating. These are deal by deal negotiations that are taking place, and certainly not easy conversations for the existing owners.
It's easy to track when interest rates go up, cap rates go up, and when interest rates go down, cap rates go down. So is there a cap rate compression story as well to the what I'll call debt financing story? As interest rates go down, valuations will go up because cap rates are dropping, and that will drive some either sales or other harvesting, or is it really too early to tell?
Well, what I'm seeing right now is overall cap rates and mortgage rates are almost equal right now on different property types. And so that doesn't leave a lot of positive leverage for equity holders. If you have a situation where interest rates go down and you alleviate a little bit of the cost of borrowing, you're going to start seeing, again, some positive leverage on a lot of these deals, which is going to entice equity to come in and possibly then compress cap rates in some way. So I would say that, yes, the drop in interest rates, mortgage rates, going to create some positive leverage situations, which will bring in, obviously, a large amount of supply and capital and make things more efficient.
So, Chris, you had a question that had come in. Why don't you pass that along to us?
I do. Viewer Drumil asks, what are the panelists' thoughts on medical office spaces, that is, office buildings that are set up for doctor's office, medical use? Jan, I'll have you direct that to the panel if you don't mind.
Okay, I'll take it first. I mean, within that medical office, or the sort of, I'll call a medical property, are a wide range of property types. There's not only the medical office building, but there's also skilled nursing facilities, and then there's other sort of, I'll call, housing within that. A lot of the reporting I've seen recently have said there's been a large increase in supply of medical office building style, and that rents are dropping quickly, and landlords are looking for alternative uses to the traditional doctor uses or medical office for some of those properties. I don't know if either of you have a comment on that. Daniel or Jean, either of you could take that.
I've seen the same thing, and expanding beyond medical office, it was also the case with life science buildings. I think for a long while, the bonus in rents that were coming with medical offices and with life science building tended to just yield a lot of new building supply and development into these two property types. And they've reached an oversupply situation where you have a lot of investments that have been put in CapEx, in lab equipments, and medical office equipments that cannot necessarily find tenants anymore. And so some of these buildings are now being marketed at just general office tenants. So it's interesting that maybe developers overdid it, seeking this bonus in rents.
It's actually still surprisingly one of the higher building uses, the life sciences and medical buildings, for actually traditional office space conversions that we've seen recently. It's upward close to 20%. And so there's definitely an oversupply situation. Agreed.
Right. So let's switch topics from, I'll call, transacting in capital markets to our consensus was at the beginning in this lightning round that maybe holding makes a lot of sense for a lot of these asset classes. So if selling isn't a great option, how should owners operate and position their properties in the current market environment, both on the demand for space side as well as a financial asset? So both, how do either the tenants or the owners think about this?
So I'll take that. For the first recommendation, or the first focus that I always look at is, and that I see current building owners look at, is take care of the building the best you can, because that's the asset, that's your collateral, that so many things really roll down the hill from there. You need to have a clean building. You need to have everything in working order. You need to have your spaces as modernized and attractive as possible. Now, I'm not saying invest in CapEx for a large variety of renovations or anything like that, but keep it attractive. The maniacal focus on maintenance really becomes very, very important here. I know it's really, really tempting to go ahead and try to cut those costs first, because the maintenance area is an expense unit, right? And so when you're trying to cut expenses, it's a pretty big number. But when you end up cutting the maintenance activities, you end up, again, you have depletion of the quality of the asset itself. When you really extend the cutting of maintenance activities, particularly things like preventative maintenance on your building system equipment, you end up with failing equipment. You end up with, you're not providing the mechanical services to the space that you need to. The occupants then become, the occupants that you do have become unsatisfied. You can end up with some, hazardous material or health issues, things like potentially mold infiltration or other toxins that can sort of enter sort of the spaces if you're not doing proper maintenance there as well. And another piece to that, if you're not keeping up with proper maintenance, you really can end up with maintenance issue becoming a capital expenditure issue. And that's really the last thing you want. If you're looking at real estate valuations, you understand the significant impact that capital expenditures have on the value of a real estate asset. And the more that adds up, the harder it just makes things worse, and the harder it is to, value the asset, transact the asset as well. And so you really, really, I just cannot emphasize enough, to the greatest extent you can, continue your focus on maintenance. And even in the courses that we have, we spend a lot of time actually in the eCornell courses talking about the maintenance activities and how to have great maintenance. One of the pieces to look at as well for fantastic maintenance, and this is probably for your whole, building team, whoever you're working with, you want to have really good leadership. I mentioned earlier the issue with labor being, if not the highest cost in the financial statement, one of the highest cost in the financial statement. And it's an old adage that people don't work for companies, they work for other people. And I think that's really true, that you really want to have the best leaders in place, the best managers in place that you can, so you can have the most stable labor force that you can. There's a lot of...
Could I challenge you on that just a little bit?
Sure.
So I'm going to take a financial owner's view of this, and I'm going to decompose my internal rate of return that I have to my equity. And I'm going to buy a cap rate, call it 7% for a building, or 6 or 7%. I'm going to finance that to a 12 or 13, okay, with my finance team. And then my asset management team is going to raise rents and manage the building over a period of time. They're going to only add like 3 or 4%, maybe 5% to the overall IRR. So the big value that I get are from my acquisitions and my finance team. I might even have a story at the end with some cap rate compression to make some money on transacting at the end. So if my asset management team isn't adding that much value, how do I compensate them in a way and get the best managers? Because all the best people want to be making more money creating value on the acquisitions or the financing team.
Well, again, I'm going to go back to, treating your people right. You've got to have a great work environment. If you're going to talk about the asset manager and the manager relationship, you need to have a transparent, collaborative partnership, and you need to set the goals, right up front with your management team and the ownership group, and say, this is what we've got to get done, and put together a collaborative plan to achieve whatever the goals are. One of the things that we haven't really qualified here is, what is the hold period? How long is ownership going to be holding this asset? And that really is going to drive almost every decision you make. When we talk about some classic asset management strategies, the first thing you look at is ownership goals in the hold strategy. And so in my maintenance discussion here, it was a little bit more aimed at a longer term hold, an owner that wants to try to hang on to the asset if they can, waiting out, the whatever our economic environment, whatever market they're in, till things get a little bit better. If you're in one of those situations where you're just biding time until you can get another buyer or convert the real estate use into something else that is more viable, then you're going to be making different decisions. But fundamentally, again, you've got to keep the building running as best as possible. You've got to keep it safe. You've got to keep it, in code compliance. And if you're ignoring these things on the building management side, it's going to end up costing you more money in the long run anyway. If you're a very short-term holder, you're just trying to, pop your cash flow to look as good as possible until you can actually transact.
Well, there's actually a play that's run. Go ahead, Daniel. Sorry.
Yeah, and I just wanted to also interject for a second in favor of the asset management team and the value they can unlock. I think the acquisition team and the acquisition decisions are made very often with an existing building or an existing plan regarding a development. Environment changes a lot. The market changes during the holding period. And I think the most important thing an asset manager will do is position the asset for sale. Positioning the asset for sale means, what do we need to do with this property so that it becomes attractive to the person we want to sell it to? And that conveys a lot of the returns on the back end. I mean, the big share of your internal rate of return is how well are you going to be able to dispose of that property. And if you sell it to someone that has a very low cost of capital, they're going to pay a high multiple on NOI. So I think the idea and what the asset manager will do is, from the beginning, they are given a property, and ideally they can look around, given the market environment, find the highest and best sale as opposed to the highest and best use, and think, wow, how can I position this property in the highest and best way to hit the best possible returns at the back end? Most of your returns could go away if you don't sell the property well. And so that's also, I think, one of the roles of the asset manager is to strategically manage the property to position it well at the time of sale. As Jean was saying, it's very much a function of who the ownership is, what's their mandate in terms of holding period, how long can they keep the property in order to execute that strategy. But certainly bringing the right operator, tenanting the property with the right tenants, having and managing lease turnovers, things like that will affect tremendously the resale value. And at the end, it will impact your internal rate of return. And all of these things are typically unclear at the time of acquisition. You buy it because it looks healthy, it looks solid, but you still have to go through the entire holding and the entire positioning so that you can sell and unlock that return.
Yeah, agreed. There's an adage that a building is always for sale, and the asset manager should always be positioning that building for optimal value and potential sale.
Yeah. So that's where I see asset management potentially bringing in a lot of value to the investment. Someone has to execute the strategy, and someone has to be clear about where the most market and the most value could be at the time of resale.
Yeah, one of the key tools actually that we work with in the courses is a strategic asset management plan. It's a plan that really dives into all the corners of the asset, the buy, the hold, and the sell strategy, which again shifts over time. But it's like it's sort of it's the document or the go-to plan that you have that, and again, it gets updated every year or maybe even more often. And it's something that you work with in conjunction with ownership, and you're constantly updating it to make sure that you're meeting ownership goals.
And from a financial modeling standpoint, I think these are strategical decisions, and that's where also models help make better decisions. You can compare cash flows under one type of resale strategy versus cash flows under a different type of resale strategies. What do they mean in terms of adaptive reuse? What should be the asset management transformation cost? What exit capital will they give you access to? All of these scenarios can be certainly evaluated through financial models, and you can then make the highest and best value decision for your asset once you own it.
So, Chris, we had a question that came in regarding the gap between green buildings and brown buildings, and if that gap is ever going to tighten or increase over time. And then the second part of that are REITs and private equity preferably looking for green buildings.
I've certainly seen specialized vehicles raising capital for so-called green investments. And so as a consequence, it's interesting to see what is time of the kind of returns that are attached to these vehicles relative to just more generic vehicles. There seems to be kind of a story to fundraise around green vehicles. And that makes it, I think, just appealing from the teams that are fundraising. They have created an avenue to get access to capital around certain promises for development that weren't necessarily here before. So just for that, I think there is something to be said about this different strategy. Whether that spread between the returns observed around the brown properties and the green properties will necessarily go away. There's operating costs that are going to be different and they could go away for sure. That's on the cash flow side. There is also differences in risk and in cost of capital, and that also could go away. I don't want to take a stand, but most probably one would expect that in the long run, a lot of the investments will be greener one way or the other, just because it is just more efficient. And so in that case, I'm not sure we'll see necessarily the gap narrow between these investments. We just may see fewer brown buildings in the long run.
Yeah. My sense is that everything is underwritten. And as you said, it's underwritten both on the numerator side, which is the cash flows that come out of the building, and it's underwritten on the denominator side as well, which is the risk side. So I think long term, the industry has accepted regulation that does make the industry itself much more sustainable and less risky. So I think there's both. There's a story that's understood on the cash flow side because these buildings have lower operating costs. I don't think the risk side is yet understood, and it will take a test of time. One little comment on your comment regarding some of these vehicles that were specialized for either infrastructure or real estate that was green. I've seen the blushes off the rose on those because the promises didn't meet the expectations when they were originally sold. And I think some of those funds are being unwound, as well as I'm not seeing a lot of new offerings because things just didn't work out as well.
And I think there is an issue with what the mandate of these vehicles was. Under the umbrella of ESG or green, it was never really clear what that objective was, and that should also become clearer going forward. What is it to invest in a sustainable way? And so once that definition becomes clear in terms of property types, locations, et cetera, I think these vehicles will make a comeback.
We have another topic, and that I really love to dive into. I'm sorry, I was typing in office conversions. We hear a lot about just how toxic offices are, how awful downtowns are because people aren't going back to office. You see these reports now. I'm seeing in my analyst reports on real estate that, oh my gosh, office occupancy is up to 2.6 days per week now. And that's like improving from 2.4 days per week that it was 2 months ago. That still really stinks. Downtowns are going to work when offices are occupied like 4 or 5 days a week, or we're going to find another use for these buildings. Daniel, I know you've done a lot of work on this. Gene, you've got some opinions too, but what are we seeing? What's going on with that? And we're seeing some spectacular transactions with things trading at 30% of replacement costs. So what's going on?
Well, I think it's a very interesting question, and it's one that is terribly exciting to be in this space and in this sector. I mean, what a chance to be working in real estate and see such a high change of land use over the last 5 years. I think technology has been a major disruptor and it's reset the way we organize human activity on the planet and land. And so that's something that obviously has consequences in terms of like central business districts, downtown. It's not as easy to change the land use because real estate is real and you can't move use that easily. And so we are facing a situation where we have a massive amount of office supply located in certain areas, and people are not that interested in being in these areas right now. How long will that behavior stand? It certainly is clear that these are ecosystems, the CBDs. Everybody depends on everybody. Lower floors depend on higher floors, but higher floors also depend on lower floors. It all holds together. If the offices are vacant, then the retail downstairs is also going to suffer, and so is transportation systems and a variety of things. So in this context, we do have a situation, which is what can we do with this massive amount of supply of real estate that is being underutilized? And there's talks of converting it, adaptive reuse, as it's called. And in some cases, it's going to work. And in some other cases, we're going to have to wait for prices to go further down because the conversion costs are so high. It has to do with the vintage of the office building. It has to do with the floor plates. It has to do with what the building looks like and can it be easily converted. It has to do with the local regulations. Is zoning going to be amenable to a change of land use? It has to do with financing costs. How much does the construction will cost? And do you have tax abatements? Because the city is losing sale taxes and property taxes from everywhere and needs someone to live in this building. So there are a lot of questions that are going to have to be tackled deal by deal, location by location. Office conversion from office to residential, with the crisis we have with respect to affordable housing, seems to be the most easy and common pursuit that people are looking at. But there are certainly all kinds of other conversions that are going to be contemplated. Each one of them will trigger a different entry point in terms of how low do the office property values need to go. That's where, again, a good financial model will help tremendously. You can map out what your pro formas would be after the conversion. You can map out the construction costs. You can map out the sequence of financing vehicles between the construction loan and the permanent loan and so on and so forth. You can include your tax abatements and the different public financing tools that are being put in place and see how low does the office price needs to go before you can actually do it. We're not seeing a lot of people doing it right now. We're seeing some sporadic cases of people converting, but we're not seeing a lot of people doing it. And I would make the case that that's where good decision-making tools like financial models are helpful. In a stabilized market, pretty much everybody knows the inputs and their relationship to the outputs, and the business models are clear. Everybody knows that if you have an NOI of such by square foot, you're good. When you have such a large amount of risk, like a conversion, then you really need to get very specific with the details, look into what's going on, get a good tool to sensitize the different inputs, understand what they do to your metrics on the back end, and talk to it with your investors. Are they willing to do this? Can you execute such a strategy? Will you see delays in the zoning process, and so on and so forth? And so based on that, I would argue that now, more than the last decade, probably, good financial models are going to help support decision-making, are going to help fundraise, are going to help with the execution. But it's a case by case. It's not going to be easy.
Yeah, I'll chime in on that too. First, I completely agree with you, especially on the sensitivity models there with that. It's been interesting and it's been a fascinating asset class to follow, especially since about 2021, when we started to notice the dynamic of the resistance of traditional office workers going back full time into their spaces there. And I think there was a pause for a couple of years where office building owners were trying to figure out, as were the lessees were trying to figure out, what are we going to do with our employees? Can we get them back in the office? Do we even want to get them back into the office? So these are starting to flush out now. These answers and these decisions are starting to be made. They're actually, in 2023, there really was finally starting to be some movement in conversions of commercial office buildings into alternative real estate uses. About 100 transactions or so, or conversions were happening, where historically maybe it was about 40 or so, but we got got to about 100. And that was probably, again, the accumulation of multiple years of planning in there. So I think this was brought up earlier. Daniel, you might have mentioned this, that the majority of the conversions are really happening to multifamily, that it's in probably an easier use. As you mentioned, the considerations of the floor plans and the window availability and all those other types of physical considerations in the building itself. The other thing, another factor that we're seeing is these other alternative uses like multifamily, like hotel, they're starting to be a little bit more aggressive in their analyses of, can we take this office building and turn it into another space? So they're approaching the commercial office building users as well. And we're seeing, multiple examples of hospitality going into commercial office buildings and converting them. A really particular piece is, for example, if it is hospitality's interested in that central business district. So the location of these becomes very, very important to whatever that potential conversion could be. Hospitality would be very sensitive to the retail options, to the restaurant, to the nightlife, to the tourism attractions, that type of thing, where multifamily would have a sensitivity to it, but maybe a little bit less depending on neighborhood attraction, that type of thing. So I think that we have to do a little bit of wait and see too, to see how these projects are converting and the success rate of those as well, depending on the use.
And I have to, just try to bring back what's the pros and cons of living in a city. I mean, why just accept that you're going to be living in a higher density environment? The pros are just amenities. I mean, amenities are available, cultural amenities are available, education, healthcare, and the cons can be at times related to crime, the time spent commuting and transportation, if you're not willing to pay the premium through being close to work. I mean, those are going to be the trade-offs that people are constantly contemplating. So cities are still incredibly attractive. They're incredibly attractive, and they haven't completely disappeared for sure, because they're still the preferred way of organizing human populations. And that's something that we should not forget when we're sort of like telling that the office sector is going to impending doom. Not at all. I think there's just a need to rebalance the amount of supply that was allocated to office in certain neighborhoods, perhaps, and we are seeing this, moving it to suburban. Suburban office sector is doing a lot better than CBD. Why? Because you have access to more space, and there is obviously in terms of the residential units. And so I think there is just a need to bifurcate the office sector into subsectors, understand what's going on. And yes, markets like Manhattan and markets like San Francisco are being challenged right now. But overall, if you look across the globe and the planet, Asia is not seeing nearly the same amount of remote work. Europe is not seeing as much remote work as the US right now. So if you were to rank also different continents, the US is hit the hardest right now with this office sort of transformation. It doesn't necessarily mean that the entire office sector is going to be penalized in the same way, whether it's in Asia or it's in Europe.
I'm going to pick up on that a little bit, Daniel. As I have traveled the world, what I've noticed is that North America is becoming more like the rest of the world in that people are now much more willing to live where they are close to where they work. And I think the reason that Asia and Europe haven't been impacted is because people do live close to where they work. And the commuting costs are lower, where in the States, you would have to, in New York, you'd come in from, Westchester, or, San Francisco, you'd come in from the South Bay. I think that will need to change. But as you said, the balance is really the key. I agree. All these cities need more housing. And then the question is, do I build something new where it's very pro forma, I sort of know what I can do, versus this conversion where I can probably maybe do it for a little bit less cost, but there's all these other uncertainties. So, and then the question and the balance always becomes, okay, so the building needs to be discounted to this value in order for it to work. And I don't think we're at a tipping point yet where it works on a wholesale way. And it's also impacted by regulations as well in terms of zoning. So I think we have a ways to go on it. Let's take a question at this point and move the conversation on, which I think is a fabulous question. If you don't mind, Chris, I'm going to reword it. But so Mike asked, do you think that real estate is priced well compared to other asset classes, creating a good vintage in that there's some room to roam? I'm going to reframe that a little bit and saying that, real estate now is one of the large, what I'll call asset classes in the world, according to the GICS classifications. And so where does real estate compete with, say, consumer durables or industrials or banking or other industries? And is it fairly priced? And can it compete effectively? Or are there places where we can look for maybe little advantages? You want to take that, Dan?
I have to be very honest. It's an excellent question, and I would need to think more carefully through it without saying anything stupid. I think it's just an excellent question. Is real estate, well priced as it is right now? I don't know.
Yeah.
I'm sorry to be dishonest.
Yeah. I mean, I feel that sort of everything is priced to perfection right now. We are in a place where things are really, really priced very fairly, if not, maybe aggressively. But the world is awash in capital that's looking for returns. And I really think that real estate is very fairly priced, and the opportunities are like in any industry. It's along the edges and the niches where people find value that others didn't see. The beautiful thing about real estate is it is real, but it is also it's at the same time it's its Achilles heel. So it's a good thing and a bad thing. But I think the fact that real estate is fixed and rents can move very quickly is a good thing for real estate. I'm going to take that question and also ask it a slightly different way. There used to be a bumper stick that was out, dear Lord, please give me another bout of inflation. I promise I won't mess it up this time because I get to raise rents. As interest rates come down, everybody's saying, hey, it's going to be great. We'll have the party again transactions, but that means rents won't go up as fast. Is that a good or overall, is interest rates coming down a good or a bad thing for the industry?
Well, the nonlinear relationship between the numerator and the denominator indicates that a drop in cost of capital is always to your favor. And so certainly seeing capital coming cheaper, even if rents are going down, would typically favor value, at least, because rents would need to drop by a whole lot before that becomes a problem from the income side. So sure, I think, alleviating the cost of capital will always work in favor. And just to come back to the previous question where I acknowledged that I was clueless, I just would like to say that I agree with you, Dan. Under the hypothesis that markets are efficient, you do have typically good pricing in place at any point in time. And it certainly is true that in real estate and commercial real estate, we have more information and more transparent information than we've ever had. So I would tend to agree with you that overall prices are fairly efficient right now, that bubbles exist. I think it was just a deep and profound question. How do you relate, the real estate to other asset classes? And that's where I was sort of stopped for a second.
I will say that real estate is less efficient in corporate governance than many other industries. I had a former colleague that said real estate's the dirty little backwater of corporate governance. And you really have to dig in, especially when things are privately held. There's just maybe it's because I follow the industry, but many of the scams and frauds that I see involve some sort of real estate angle to them.
There's a lot.
So I do think we have to worry about that. But I think in the end, as Daniel says, data's getting my career, now that I'm retired, but my career was really dominated by an incredible increase in transparency and information that made the industry better, mostly by lowering its cost of capital.
Yeah.
We have another question, Chris?
Yeah, we do. We have one from Natasha, who switches gears a little bit. And Natasha asks, the extended stay hotel sector has experienced a remarkable evolution over the past years and has become an interesting asset, not only for traditional hotel investors, right? What are your thoughts about this asset class? Buy or hold?
I can take that one if you want. I think, yes, it has experienced significant growth. It really shot through the roof right after COVID, or right as we were, the country opened up again after COVID. It's an attractive sector in lodging for its space and travel. It is received enhanced use for the remote worker who can work anywhere and needs extra space, needs the extra desk, wants the couch, wants sort of the studio apartment type of look for family travel. Very, very attractive as well. The P&L model for it, or the cost model for it, is highly lucrative. The net cash flows are typically very high. They don't have the heavy overheads of food and beverage spaces or some of the other amenities that can drag down profitability in a traditional full service hotel. So the brands have become more aggressive with their distribution of them as well, as demand has increased, even bringing in new brands for extended stay as well. It's also a little bit more encouraging now that some of the larger city centers have put in those regulations for Airbnb, and that we're not having this huge supply of these apartments for rent for business travelers as well. So that's opening up more room for these extended stay products. So I'm bullish on them, yes.
I'd hold everything you can and buy more.
And I think there's another way of looking at extended stays, which is that an extended stay property is kind of a call option for a residential owner. They can easily convert to extended stay, take advantage of higher short-term rent, and then when that market sort of slows down, then you can go back and sell that option and come back to your residential long-term play of having annual leases. So the cost of conversion from residential to extended stay typically is minimal, and you can ride the short-term to long-term to short-term if the regulation locally permits it. So it's a free option if you were to think about it. Someone that has a residential unit can unlock additional value by adopting the mindset of extended stay and then coming back, which is not...
I agree. It's really, to me, it's a lease length question. What's your average lease length? And you can even section off different pieces of your building and have shorter leases and longer leases.
Right.
There are some regulations around that. I'm going to bring up one case study example of something that that we got 3 minutes at the end. I was reading recently, there's some hotel strikes, and this was an analyst note about some of the companies that might be hit by this hotel strike. And they were talking specifically about California and San Francisco, where there's some owners there that have walked away from their mortgages because it's less costly than trying to sell the property to get rid of it, because the combined cost of a labor strike and seeing increased operating costs, plus there's a 10% exit tax on very high value buildings, made it unviable for you to actually try to sell the building. So they just defaulted and walked away, and that was a lower cost option. It's interesting that the commentator mentioned the exit tax, and I'm wondering if you're seeing this as something, not just the exit tax, but these sorts of scenarios where people default because it's less costly than trying to sell.
I know that there are multiple ownership groups that have taken on that strategy. When you're establishing, when you're buying these assets, you're putting them in their own corporate entity, and so you're sheltering yourself, or you're protecting yourself from the default to the rest of your assets. So I feel like it's something that owners are still looking at, absolutely. And as the labor issues have, obviously they're in the news today, as they're bubbling up, and depending on what the labor contracts look like on the back end, we don't know what they're going to look like, but we could see more of it, absolutely.
Thanks for listening to Cornell Keynotes, and be sure to check out the episode notes for more information on eCornell's online real estate certificate programs. Thanks again for listening, and subscribe to stay in touch.